As a result, advertisement expenses grew by 11.8% year-on-year. Other expenses grew by 17% year-on-year. Cost of strategy consultant and increase in minimum wages at Ahmedabad and Aligarh facility drove up the other expenses. EBITDA degrew by 51.1% year-on-year to 127 million rupees. The company reported profit after tax of 3 million rupees, which includes 34 million rupees of deferred tax liability, a non-cash item. With that, let me share some of the highlights of operations for the quarter, which will also cover category growth and market share numbers as per the MAT December 23 report of Nielsen and IQVIA. Zydus Wellness portfolio brands were available in 2.9 million outlets as per the revised reporting of Nielsen for MAT December 2023. Therefore, we are readjusting our plan for availability to 3.5 million outlets over the next 3 years. We continued our thrust on marketing initiatives to grow the categories and increase our market share of our brands during the quarter. On Glucon-D front, the glucose powder category has grown by 4.4% at MAT level. Glucon-D brand has grown faster than the category and registered strong growth for the quarter. The brand has maintained its number one position with a market share of 60.0%. On the Complan front, the brand has registered ahead of category volume offtake growth. With continuous efforts and interventions for demand generation, Complan has witnessed 16% growth in penetration at MAT level. The health food drink category has registered a growth of 5.8% at MAT level. Complan market share stood at 4.3%. On the sweetness front, we continue to push consumption of sugar-free green with our media campaign with celebrity Katrina Kaif, which was further amplified with digital campaign during the 2023 Cricket World Cup. The brand maintained its market leadership with market share of 96%. On the personal care front, Everyuth brand registered yet another quarter of strong growth. The face scrub category has registered a growth of 7.6% at MAT level. Everyuth scrub continued to maintain its leadership position with market share of 44.4%, which is an increase of 263 basis points over the same period last year. The peel-off category has registered a growth of 4% at MAT level. Everyuth peel-off has maintained its number one position with a market share of 79.5%, which is an increase of 113 basis points over the same period last year. The prickly heat powder category has grown by 2% in 2023 MAT December. Nycil brand has grown faster than the category and maintained its number one position with a market share of 35.1%. As we speak, we have finished our season's preparedness and have started replenishment of fresh inventory across trade channels. Our demand generation and brand building efforts will continue, which will drive the growth of the company. The company's journey towards innovation will propel the growth further. Thank you, and we will now start the Q&A session. Over to the coordinator for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Sanket from Ambit. Please go ahead. Mr. Sanket? Since there is no response, we'll move on to the next question from the line of Kinjal Mota from Banyan Tree Advisors. Please go ahead.
Hi. Thank you.
Can you use your handset mode, please? You're not very clear. Sorry, you're not audible.
Hello?
Yes.
Am I audible now?
Yes, please go ahead.
My question was related to deferred tax adjustment, which was mentioned during this quarter. could you please give some details on what it is? And second thing is, why is the 9-month FY24 tax rate negative? These are the two questions, if you could help around.
So this is, because on conservative basis, we created a deferred tax asset in the earlier quarters. And because there are in the standalone entity of ZWS, there are profits, and we had to reverse this as a deferred tax liability, and therefore you see it as a line item in the P&L.
It's a non-cash item.
It's a non-cash item.
Kinjal, we are unable to hear you.
Okay, yeah, got it. And the second question is, what is the MAT credit entitlement? So the amount is adjusted for 188 million, which is mentioned in the note?
Yeah. So MAT entitlement was mentioned even in the last year's balance sheet as well. So, because we are in the zone, in the Sikkim, where we have, this availability.
Okay. Fair enough. And what is the tax rate that we could expect for this year, FY24?
So FY24 and FY25 will be in the nil tax rate, and thereafter will be paying the normal tax.
Okay, perfect. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone now. The next question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
Thank you for the opportunity, sir. Sir, I wanted to understand, when I look even on a Y-on-Y basis, our sales have declined, but we have gained share in a lot of our products where we are already market leader. We have gained additional share. So if you could just help me understand, why is that the FMCG market is growing, but it's not moving into our sales growth?
So I think if you look at FMCG market, I think there has been a challenge. While for the last quarter, Nielsen has reported a 6%, but most of the categories are struggling to get growth. For us, also, if you de-average the whole business, the personal care is showing a fairly good growth, and which is what we've also reported. It's the food and nutrition which has not grown. So I think the impact is category by category. Overall, there is a pressure on demand, and the categories are a bit of stress. Fortunately, because of our actions, we are in a good competitive situation. Our market shares are going up despite the market pressures or category pressures. And we believe as we move forward, as the demand improves, I think the category growth will be back, and we should expect improvement in overall growth and specific to those categories where we've had brand-led pressures.
Sir, when can we see? So you said that demand, but is there a timeline in your mind as well as some kind of quantity, like number, if you can say that we can grow up for FY25 as well as 26?
So if you look at it, I think we had even in the last call also mentioned that Q4 onwards we should see the growth.
Mr. Rathi, can you please mute your line? There's some disturbance coming from your line.
Yes.
Yeah, sorry sir, please go ahead.
Yes, sir. So even in the last call, we had said that we expect growth to be coming back from Q4, and that's what I think it's looking like. That demand is improving, though early days, and it's only green shoots. But we expect growth to be coming back to normal starting Q4, and our wish list is, or our expectation is that FY25 should be back to normal double-digit growth that we work for.
Okay, sir. So we are. So there is some kind of growth that we see in Glucon-D for this Q4 as well as Q1 earlier year, which was not very well for us.
So the earlier year, as you said, was subdued, but we still have to wait until March and April to understand how the season is going, but the start is good.
Okay. Thank you, sir, and all the best.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone. The next question is from the line of Karan Bhuwania from ICICI Securities. Please go ahead.
Hi, team. Thank you for taking my question. So firstly, on sugar-free, that you have mentioned in the PPT also that despite the headwinds, there has been good uptakes in terms of volumes, right? And so if you could elaborate more on that as to how has the demand been of the sugar-free products, especially the products that are based on aspartame.
So let me give you an overall sweetness portfolio and how our business has been. I think we've had two things that have affected overall sugar-free business. One has been the Sugarlite not being there for a major part of the business, and aspartame has had a muted run post WHO. Most of the growths are being driven, and we've seen now several 11, 12 quarters of consistent growth of sugar-free green, which is a stevia-based product, which is covering up for it. We are seeing good offtake momentum coming from Nielsen, and which we hope will help us recruit more consumers as we move forward. A lot of concerns over what affected seem to be reducing, and we hope to be able to convert into better improved penetration over the next coming quarters.
Thank you, sir. Thank you. So if you could just highlight what was the contribution of Sugarlite, which was not there in this quarter, so that will be helpful to understand the growth better.
So Sugarlite at an overall level, annual level has about a 1.5-2%. Of course, in the smaller quarters, it gets more accentuated.
Got it. Secondly, sir, on Complan, are you seeing any increased competitive intensity versus previous 2 quarters? Is there any change in terms of competitive intensity, in terms of pricing or say distribution that you are seeing right now?
No, not really. It's the usual. It is a very competitive category, and it continues to remain so. The good part is that we've been able to take some price increases, and with the milk getting stabilizing, we expect it to be in a better shape both ways.
Got it, sir. Thank you. I'll come back in the queue for questions. Thank you.
Thank you. We have our next question from the line of Priyank Chheda from Vallum Capital. Please go ahead.
Yeah, sir. My question is on what was the volume growth for Q3?
It's what volume growth for the quarter is in line with the total growth.
So it's almost the same parity, -3.
Okay. My next question is on how do we look into the growth of -5% for food and nutrition segment?
From the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Good evening, sir. Thanks for giving me the opportunity. Just wanted to understand on your initial comment of seeing a good improvement in quarter 4. So is it because that there will be a lot of offtake prior to the summer season? Is it because of that, or overall you are seeing some material changes in the demand environment?
Very good improvement in?
Good improvement in performance in Q4.
So I think there are two parts to it. Of certain season build-up which happens across in our portfolio, which happens where the wholesale and the distributors start building up in January, February, or February, March, because the season is coming, which is part of the portfolio and which will happen, which anyway looks good. But we are also seeing some green shoots of demand, and we are expecting all our some of our initiatives playing out, which we have put in place. So put together, we believe that quarter 4 should start, help us take it to the next level from where we've seen quarter 2, quarter 3 demand for our portfolio.
So I think as Arun said, it's a summer skewed portfolio of at least, and quarter 4 is loading. So it happens every year. So assuming that this is a normal summer, we will see better traction.
Right. And Q1 should also be good considering the fact that last year Q1 was affected by unseasonal rains and all. So I think even Q1 should also be good for us.
If we have
considering the base.
Or Q1. If we have a better summer, Q1 will be the main growth driver for this quarter for FY25.
Okay. Okay. Thanks.
Thank you. We have our next question from the line of Ajay Thakur from Anand Rathi. Please go ahead.
Hi. Hello, sir. Thanks for taking my question. So, wanted to check on 2-3 things. One was on the sugar-free. Adjusted for the sugar-free light, can it be kind of, just of one quarter kind of a phenomena, or we can expect that sugar-free light will be kind of, hitting the markets sometime soon? And how are we looking at, filling that gap in terms of sugar-free light?
That is in place, but we'll discuss once we launch.
Yeah. So I think we've started at it. I think from March starting, we should be back with a normal momentum on this sugar light or equivalent space. And we will, in the next quarter, be sharing a more detailed strategy where we believe because of this innovation and our capability, we should be back to normal business in the following quarters.
Okay. And sir, wanted to get more sense on the international business. What would be our run rate right now for 9 months in terms of the international business as a percentage of overall sales? And what are the the growth drivers that we are looking forward to for the next year in terms of growing it faster?
So in the 9 months gone by, we've had a double-digit growth. However, it's been impacted by specifically Africa market, where we've had some challenges, specifically our largest market, Nigeria, where there were macroeconomic challenges. But most of our other markets like Bangladesh initiative, Middle East, are firing as per plan and good to build up right. But at an overall level, it'll still be closer to 3.5% because of the challenges we face. So that's really where we are.
Understand. And for the drivers, going forward, how are we looking in terms of growing the international business, say, for the next year?
So like I explained, there are these 3 markets we've identified: Nigeria, Bangladesh, and Middle East. Nigeria, while we'll look for solving for the macroeconomic issues, in terms of our Bangladesh initiative where we are investing, we created our subsidiary and we are pushing stuff. We expect good traction. We're already seeing some fairly good traction on that. Plus, we're launching new products, some of which are available in our investor deck. We're starting with Middle East and we'll extend it to other markets as well on sugar-free delight.
Understand. And sir, lastly, in terms of the price increase, so I believe we have taken some bit of a price increase. But when given the fact that in the current quarter, if I were to look at it, it is kind of a flattish price increase that we are seeing. Can you just give some bit of a indication of how this is like to trend in quarter 4 and onwards in terms of the price increases? Is there something that we can expect in terms of price increases going forward as well?
So I think it's a mixed bag because, like I explained, Nutralite we had to, because the oil prices come down, so we have to pass on. The net margins are good. So we'll take calibrated price increases on some of the brands, but some others will not be. So there's no overarching complete price increases, but we do expect to continue to inch up our margins, gross margins. And that's really the focus, to get back to our FY21 numbers too.
Understand. Thanks, sir. Thanks for that.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. The next question is from the line of Devansh Shah, an individual investor. Please go ahead.
Yeah, hi. Thank you for taking up my question. Actually, sir, if it's okay, then I can speak in Hindi also. The mix of that would be much more appreciated. Sir,
okay.
Haynes India we have purchased Haynes India by 4,500 plus crore company in 2019. I can see in balance sheet, the operating profit margin before that was 20% plus. in 5 years we are nowhere near to this. So is it a good purchase, or it's like what has been happened and you are now trying to survive only for all these things? Because your markets, what we are seeing in the market, what we are seeing in the brands, where are we standing? So it's a really, I'm an individual investor, sir. I'm a retail investor. So I have my own perception for that. But sir, 5 साल के बाद we are at nowhere near to some 18%, 20. Dividend payout is also worst. It's going on worst part. Complan India, Haynes India was a good company before that, or after buying that we have disrupted the company?
So I'll give you a short answer, and if you need more details, you can connect with our IR and we can explain a little bit more.
Yeah,
I
sir.
think there are 2 parts to this. So, can I?
Yeah.
Answer?
Yeah, sir. Yes.
So there are two parts to this. I think at an overall level, there has been 2 or 3 fundamental changes from 2019 to now. One is a substantial GST budgetary support which you've stated on records, which is almost 30 crores to the EBITDA, which is missing in the base number, which is not there. Second is 21 on FY21 after that, there's been a substantial inflation which has impacted gross margins for all FMCG companies, including us, largely impacting by milk, oil and other factors and DMH, etc., which has impacted us. While we managed that with a lot of our cost cutting, but like many other FMCG companies and much smaller than some other companies, our EBITDA margins have got impacted. Having said that, we do believe that over the next 2 years, our EBITDA margins can go back to 17-18 that we want to do, and with our actions in place. Talking on the top line, I think from what we acquired, 3 brands that we acquired, Nycil was at 31% market share when we acquired. It's already at 35. We believe our margins as well as all our actions in the place, we have increased the margins, we've increased the market share and the presence of Nycil, which has been more successful with us. In Glucon-D, which has had a little bit of more volatile run thanks to COVID and last year's summer season getting impacted. Market shares have got consolidated from 58% to 60% plus. The category has gone through a pressure because we defined the category and there was a penetration hit in 2020. But post that, our penetration and more consumers have come on board. We believe this will continue to build forward. We have a job in expanding the category to the next level, which is what we are working on. So both these have demonstrated a substantial consumer acquisition, margin improvement, and better execution. Third brand, which is more talked about and was already under stress under Heinz when we acquired, had already dropped from a double-digit market share to a mid-singles. I think it was a known challenge which we took on. We believe we will be able to do it better. Of course, there are challenges. We are still at a very similar level of market shares that we acquired it at, closer to 5%. We have probably lost 0.2, 0.3% over that because the market has not expanded. And to make it worse, the milk prices have impacted the margins. The good thing is that while the leaders dropped the prices, we have held our nerve. We didn't drop the prices. We played with the price point and held ourselves well. We believe with more actions in place, like we have discussed, we are good to build this brand forward as the prices are getting better from the input prices. And the competition is also realizing that low prices is not the way to build brands. I think our margins will improve and we are on par to recover our shares. But that's a little bit longer haul than we estimated at that point in time. But at an overall level, despite all the macro and other things, I think the Zydus Wellness team has done an exemplary job of integration, making it one team and taking some of these brands forward. I think from where we acquired Heinz brands or so-called iconic brands that they are in better home and they will become only larger from where we are. So that's my view. More details, of course, we can share in a separate conversation.
Yeah. That's a normal. I understood the thing. Otherwise, there should be some part on the annual report also regarding this. And 5 years, where are we standing? So we can understand if FMCG or some sector is going through some of the hurdles or they are not in the correct flavor of the market. वो हम भी समझ सकते हैं कि सर FMCG is not the flavor of the market from last 2 years or 3 years. But सर ये रिटेल बंदा भी समझेगा कि सर I have never seen in my life कि मिल्क के प्राइस घटे हैं कभी भी inflationary points पे. I have never seen this in like 20 years. Like 20 years would be a very small to justify something like this. But sir, my genuine question was regarding that ke before that, company was having only 2-3 brands, which were the market leaders. Operating profit margin acha tha. And now you are telling that in 2 years you are going to come back over there. That's a good part. That's all. That was the major question from my side or from the retail side.
Thank you.
Thank you.
Thank you.
Thank you very much.
Take care.
Thank you. We have our next question from the line of Mayur Parkeria from Wealth Managers India. Please go ahead.
Good evening, sir, and thank you for taking my questions. Am I audible? Just confirm.
Your volume is very low.
Is it better now?
Are you on your handset?
We can hear you.
Okay,
Yeah.
please go ahead then.
So actually, somebody just took away the thought, and it was also similar. I also had a similar question, maybe a little more diplomatically and nicely put, regarding the same hens portfolio. Let me just, you have summarized your actions and what we have done over the last 5 years well, and you have also tried to give us some understanding of how we look at over the next 2 years, so that will help us. I'll just add a small aspect here, and if you can clarify that also. And from a shareholders' return perspective, now I understand that management can execute their strategy. Markets will do their own things, right? We know that. But over very long periods of time, and 5-6 years are long period times. Obviously, there was COVID, there were other aspects. We understand that. But having said that, it's a 5-6 years, and other companies have done relatively better, if not something very phenomenally great. But they are still continue to do better than. From that perspective, from a shareholder wealth perspective, do you believe? I'm not asking 1 quarter, 2 quarter, 1 year, the kind of outlook on stock prices or something, but in general, for promoters and owners are the largest shareholders here. And do you believe that now this quarter marks the bottom as far as many of the aspects which were concerned with respect to demand, with respect to costs, with respect to initiatives, with respect to market share and brands, and some of the changes which had to be done? Do you believe everything is now largely behind us and we are on a trajectory where long-term investors and shareholder returns can see an uptick from here on?
From a cost point of view, I think this is the lowest we've seen. So cost-wise, we should be only getting better, hopefully, with no crazy situations happen. Demand is clearly a situation which is dynamic in nature. Right now, we are seeing a positive movement, and we do expect things to only get better from here. Just from a market share point of view, we touched our peak of last 5 years across most of our portfolio, and we remain positive about building on these market shares. So competitively, we are in good shape. We are looking at hopefully demand only getting stronger. Cost-wise, we remain again positive that we will improve our gross margins and we'll be able to take it to our bottom line.
So 17-18% kind of margins in 2 years will be largely led by gross margin improvement?
That will be the biggest driver, and the operating leverage if demand plays out the way we are expecting, at least. That's the largest 2 factors.
Sir, we have also reduced the debt over these years substantially, and now practically debt-free kind of status. We are coming back to normalcy as far as the balance sheet strength is concerned. Why can't we increase our direct reach or the reach? Just a theoretical question, but just to understand your strategy, why can't we reach 3.5 million outlets in 1.5 year instead of 3 years? Just a question, just a period, because you mentioned. Means what stops us to grow our distribution? Now we have the strength. Is it spending which is the curtail, or is it just the market dynamics, or our conservative approach in which we want to build this?
We're not conservative. Actually, when we acquired, we were 2.4 lakh outlets. Now we directly cover more than 6.5 lakh outlets. 2.9 million outlets is where our products are available, but our direct coverage is only 6.5. Overall, we've seen the general trade being under pressure over last couple of years, where a lot of consumers have shifted demand to e-commerce and non-trade. That accounts for almost 21% of our business. So while we are driving our general trade reach, we are also conscious of our cost to serve. So it's a balancing of expansion as well as cost parameters. We are reasonably bullish and capable, but we'll do it in a calibrated way so that our costs are managed and not just driving it for the sake of it. So it's a balancing the two sides.
So last question from my side on Everyuth. Apart from the scrub and the peel, is there any product which you see as potential to grow and which has over the next 2 years, obviously long term it is possible, but over the next 2 years which is positioned in a manner compared to peers or in a category which can give us enhance this growth rate in the category which is there for the overall brand itself?
Simplistically put, I think scrub and peel off can give us all the growth that we need, but we've had at least 2 or 3 more initiatives. We've launched body lotion. We are working on channel-led specific initiatives on face wash. We have a couple of benefit-led segments like D10 portfolio, which will add to this growth. But our core will continue to drive based on increasing their penetration and reach. Is how we feel there is enough scope within the skincare to grow up that.
Thank you, sir, and wish you all the best.
Thank you. We have our next question from the line of Malhar Sanghavi from Vama Financial Services. Please go ahead.
Hello, good evening, sir. Am I audible?
Yes, please go ahead.
Yeah, I had a question on ImmunoVault. Has the demand for that picked up as you expected? And if not, then what's hindering the growth there?
So it's still a small part of our portfolio. It is still very small, and we're working on driving it further.
And one more question just to follow up on the stevia-based sugar-free. So that's supposed to be a more healthier-based sugar-free, if I'm not wrong. If that's the case, why is it not showing as much growth as it should? Like, why has it not picked up the way you expected it a couple of quarters or a couple of last year?
Sugar-free green, as we call it, stevia-based sugar-free, it is driving. It has been growing for 11, 12 quarters in high double digits, and that's what we've talked about. So it is actually driving the major part of the sweetness portfolio.
And lastly, if I'm not wrong, Sugar Light is doubling each year, right?
Sugar Light, it was doubling each year. In last few quarters, as we mentioned, there was a trademark litigation, and that has impacted our business and impacted our sweeteners and overall business portfolio.
Right. So just want an update on that. Like how is the distribution being affected?
Post-March, we should be back and selling it, and post that we will share in the next quarter our plans and strategy on that.
Sure. Thank you. All the best.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I would now like to hand the conference over to management for closing comments. Over to you, sir.
Thank you, everyone, for your questions. We hope to have a good run in 2024 and wish you all a very nice, healthy 2024. We'll see you in the next quarter results. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.